Hey folks, did you know that 53% of Canadians, they are living paycheck to paycheck, and 25% of that number actually is also living on debt? Right across the border in the United States, 65% are also living paycheck to paycheck, according to a study by CNBC that was released in April 2024. So in your 30s, the decisions that you make about money, they have a huge impact on your future financial stability. So it is crucial to be mindful of how you manage your finances during this pivotal decade of your life. For those who don't know me, my name is Isaac Jonas. I like to talk about personal finance and investing because for me, finance is a very important pillar of my life, in addition to health and other things that I value. So one of the common money mistakes that I have observed and experienced by talking to friends is that a lot of people, they tend to overspend. It is easy to be caught up in the desire to catch up and be like the Jones, in other words, to get instant gratification, splurge, and especially with the advent of social media. And I'm not saying it's not always bad. It is very easy to have lifestyle inflation. In other words, if your salary increase or your income increase, then to increase the spending as well. So the truth is, the earlier that you start saving and then investing, the better that you will be in the future. So let's deeper into the consequences of these money mistakes. Overspending can lead to high levels of debt if you accrue debt, and then it can also make it difficult to achieve financial milestones like buying a home, starting a family, living a debt-free life, and even neglecting the retirement planning or savings can also result in you working longer than anticipated or facing financial hardships in your golden years. So instead of enjoying the retirement, spending time with grandkids, and also enjoying quality time with your loved ones, then that situation would potentially cause you to continue working, because actually for me, I live in Canada, there are bills that I have to pay whether I'm working or not, right? And I'm sure it is the same from people across the whole world, because that's just the way life is. So by not addressing these issues of overspending, debt in your early 30s, you are setting yourself up for potential financial hardships down the road. But here is the key insight. Making smart financial decisions in your early 30s or even now can set you up for a more secure future. By prioritizing saving and then ultimately starting investing wisely so that your money can compound and grow. In other words, I emphasize it is very important to invest in things that you understand. I like to invest in companies, in the stock market, or even any deal that comes before me. I want to scrutinize and make sure that I understand. And it's okay to not invest in everything, because it's one way of not losing money. I've seen a lot of people and adverts that promise people huge returns, to say, oh, invest this money on this stock or on that, you make 50%, 40%. Yes, that could be possible, but it's highly unlikely to get such returns. I did mention in my most recent video that 90 to 94% actually of the investors, professional investors in the United States, over the past 20 years from that study that I was studying, I will put it here for you to see, they failed to beat the S&P 500. That is the index, that is a major gauge of the economic performance in the US. And of course, there are other measures that are used to measure the economic growth in the United States and in the world as well. But those top 500 companies, essentially, they are companies that then create exchange-traded funds that mimic or track that index. And over the past couple of years, they have retained an average of about 10%. I was looking at the history of the S&P 500. It was started, I think, in 1923, 1928. That's when there is more data. But over the years, it has gone up and down. There was the Great Depression. around in the early 30s, and it dropped even by even more than 40%. But what has happened is that it goes down and up, it fluctuates in other ways. But for those who hold long enough and even aggressively add more shares, buy more shares when it drops, then that's another way to actually amplify the returns. And this is not investment advice, by the way, but that's what I've seen, because it's a basket of those companies. But like I like to do in my own investment strategies, I like to invest in individual companies that I understand only when they are really down, so that there's a margin of safety to say, let's say it drops by 40-50%, the fundamentals are still great. In other words, the financials, the return on investment is at least 15% per year from history. They have consistent cash flows for the past 10 years or even 5 years if it's a startup that has started. I like to see their revenues, but most importantly, their long-term debt falling over the years, and then use that to check as the ratio of the free cash flows. In other words, they will be able to pay off their long-term debt. The economy can have a lot of unexpected surprises. Let's say the central banks might decide to increase interest rates, which might increase the cost of borrowing. So if the companies, individual companies that I'm investing in, they don't have strong fundamentals, they're more likely to not weather that storm. So I look at those companies, and I particularly like individual companies that have a lot of cash on their balance sheet. I was at the Berkshire Hathaway shareholders meeting in Nebraska this past weekend. Warren Buffett revealed that they have, I think, over 180 billion just in cash, and they are not seeing opportunities to invest. And that's what happens is, if you're an investor, it's also good to have some cash. So those are some of the things that I have realized, that once you have savings and you understand that you're not overspending, you have extra money, that can help you to secure your future. Some people, they go to the bank, there's nothing bad about that, and have the bank manage their finances. And of course, for a fee, mutual funds, usually they charge about 2% here in Canada. I don't know other parts of the world. But to wrap up, it is essential to avoid these money mistakes of overspending, accruing a lot of debt, lifestyle inflation, right? Not investing and not even budgeting or tracking your finances. So I like to prioritize saving by conclusion, and then investing, and also understanding the things that I invest my money, and find ways to increase my retirement income. Fortunately, in Canada, we have a very robust retirement plan. There's the Canada Pension Plan, and also the Quebec Pension Plan for those who live in Quebec, but also the old age security. But also there are other opportunities for people to invest in their tax-free savings account, and also other registered accounts. And I'm sure in other countries, including the US, Australia, or around the world, it's very important to understand the tax code, because there are a lot of opportunities which mostly the rich people exploit. Not necessarily in a bad way, because they just read, they understand the tax code, and then they use it to their advantage. So it is very important to avoid overspending and accruing debt, especially in your early 30s, and then you invest your money so that it can compound and grow. That way you set up yourself for financial success in the future. Remember, the choices that you make now can determine the financial well-being of you and your loved ones. So I'd love to hear from you, your own experiences about money management, and in your 30s or whichever age that you are, please leave the comments down below. And if you found this video helpful, please don't forget to subscribe and hit the subscribe button so that this video can reach far and wide. Together, let's navigate the world of personal finance and investing and secure a bright financial future. Thanks for watching. Have a wonderful day.